Okay. Good evening, my dear students. Welcome to the CA final live coaching classes for indirect taxes. We are presently in the topic of the input tax credit. I hope most of you attending today's class have attended the previous class because the previous class had the basic concepts of the input tax credit which were covered. So it is very, very important for you to have attended the previous class. Only then for you it will be easy to follow today's session and the various sections what we are going to discuss. In today's session, we are going to cover section 18, which speaks about the credit in certain special circumstances, as in whenever there are situations where the nature and character of supply changes, that is a supply which is exempt, it becomes taxable, or wherein a person who is under the regular registration shifts to the composition scheme, and a person who was in the composition scheme shift to the regular scheme. So certain scenarios like that will be covered in section 18 along with the respective rules. And in those cases, what has to be done also is given clearly, and accordingly the rules have to be followed in the cases which are covered in section 18. Fine. So therefore, let us go through the section first as always, and after we go through the section, we will summarize the section and the various important points which are covered in the respective provisions. So section 18 subsection 1 clause A. 18 subsection 1 clause A speaks about application for registration when he becomes liable for registration. That means what? A person, when does a person become liable for registration? You will understand this concept better in the next chapter, which is registration under GST. For us, in simple understanding, let us just understand that whenever a person crosses the threshold limit of 20 lakhs, in most of the cases it is 20 lakhs, but in some cases it is also 40 lakhs. But for the purpose of our understanding and ease of understanding, we will take the amount at rupees 20 lakhs. So therefore, a person whose aggregate turnover crosses 20 lakhs during the financial year, he becomes liable for registration. That means he has to apply for registration. So therefore, this particular section covers the concept where when a person becomes liable for registration and he has certain stocks and inputs which are present, okay, he becomes liable for registration. That means his turnover crosses 20 lakhs, and at the same time he has certain stock, he has certain semi-finished goods or finished goods, and inputs are there in the stock. In that particular situation, the section says that he can take the input tax credit in respect of whichever inputs are present. So therefore, when we are going for this rule, you should understand the date on which the date which has to be taken into consideration for taking the inputs and stock into account is a very, very important thing here. So the date is basically on the day preceding the date from which he becomes liable to pay the tax. That means the day when two conditions have to be satisfied here. The first condition is he has to first become liable for registration. Once he becomes liable for registration, in that particular situation, he will once he becomes liable for registration, just one point. Yeah, the moment he becomes liable for registration, that is his turnover crosses rupees 20 lakhs, and within 30 days he has to apply. He has to apply for the registration within 30 days, and he should be granted the registration. That is the first condition to be satisfied. In that particular situation, you have to take the date preceding the date on which he is liable to pay the tax. On that date, whatever stocks are there, the credit of the input tax can be taken. Okay. Let us first take an example to understand this section better. So therefore, here Let us take an example here. Now, A is a taxpayer. I hope you are able to see by the screen. A is a taxpayer and his turnover crosses rupees 20 lakhs on 5th February 2023. Okay, this is the aggregate turnover. Okay, so this turnover here is very important. It refers to aggregate turnover. So at that time, let us assume he has stock of rupees 1,50,000. Okay, he has stock of rupees 1,50,000. The goods worth rupees 1,50,000 he has. So till now there is no concept of input tax credit because he was unregistered. So he has a stock of rupees 1,50,000. Now he has to apply for registration and get registered within 30 days from 5th February. Okay, 30 days from 5th February. So therefore 23 days left in February 7th. So therefore registration should be taken by 7th March 2023. So therefore once he takes the registration, what ITC is available? ITC on day preceding date on which he is liable to pay the tax. This has to be taken. So therefore, what date is important here? Date is 4th February 2023. So 4th February 2023, whatever inputs are there, on this date, he can claim the respective, whatever amount of goods and semi-finished goods or finished goods are there on this particular date. On those, whatever input tax, that is whatever GST he has paid, that can be claimed as a credit. This is what section 18(1)(a) says. So I hope that is clear. So now we go back to the section. Good evening, Rashmi. Okay, so I hope this point is clear for you. Right? So now we go to the next point, which is 18(1)(b), voluntary registration. So first one, please bear in mind 18(1)(a) talks about application when he becomes liable for registration. Okay, 18(1)(a) clause B talks about voluntary registration. Now, what is voluntary registration? We have to, at this moment, go and study section 25 subsection 3 as well, which speaks about the voluntary registration. What does 25 subsection 3 says? That in case the turnover of the taxpayer does not exceed the threshold, but still he wants to get registered under GST, he can still opt for the voluntary registration. Okay, so therefore, why is voluntary registration usually common? Because these days what has happened is the presence of a GST registration has become mandatory if a person wants to attract big customers. If a person wants to attract very renowned customers, the presence of a GST registration has become mandatory. So therefore, for this particular situation, he takes the voluntary registration as well. So the moment he takes a voluntary registration, he becomes a taxable person, and all the turnover he has to pay the tax. Now, there is a common misconception which says that usually if a person gets himself voluntarily registered, till rupees 20 lakhs he did not pay tax. This presumption is not at all correct. The moment you are registered under GST, on whatever money you are charging, on that GST is applicable straight away. So therefore, now we are looking at a situation where a voluntary registration, a person wants to take the voluntary registration, he also can take the credit in respect of inputs held in the stock and inputs held in the semi-finished or finished goods held in the stock on the day immediately preceding the grant of registration. So whenever the registration is granted, so you're applying for the voluntary registration, you're getting the registration granted. One day before that, whatever stocks are there, whatever inputs are there, on that the respective GST can be claimed as an input tax credit. So that is 18(1)(b) talks about voluntary registration. 18(1)(a) talks about liable for registration and gets registered within 30 days. I hope this point is clear. 18(1)(a), 18(1)(b), I hope you understood what is the difference between the two. Now we come to 18(1)(c), which talks about a person shifting from composition scheme to regular scheme. Okay, composition scheme to regular scheme, he is shifting. That is when we have seen section 10. When does a person opt for the composition scheme? When his turnover is below 1.5 crores for three categories: manufacturers, traders, and restaurant service providers. For service providers other than restaurant service providers, the turnover limit is 50 lakhs. So therefore, in this particular situation, he takes the voluntary registered and he shall be entitled to take the input tax in respect of the inputs. This clear. I'm sorry, composition scheme to levy. So where any registered person ceases to pay the tax under section 10. When does a person cease to pay tax under section 10? The moment his aggregate turnover crosses 1.5 crores, that is the first situation. And the second situation, where he feels that the composition scheme is not beneficiating and he wants to shift to the regular scheme, that time also he will shift to the regular scheme, right? So where a registered person ceases to pay the tax under section 10, so that means he no longer opts for the composition scheme, he shall be entitled to take the credit of input tax in respect of inputs held in stock, inputs held in semi-finished or finished goods, and on capital goods also on the day immediately preceding the date from which he becomes liable to pay the tax under section 9. Very, very interesting situation. The fundamental difference between 18.1c and 18.1a and 18.1b is the addition of facility of claiming the credit of capital goods as well, right? So therefore, composition scheme to regular scheme means whenever you are shifting to the regular scheme, you have to see the stocks, the inputs which are there in the semi-finished or finished goods, and on the capital goods on the day immediately preceding the date from which he becomes liable to pay the tax under section 9. That is nothing but when the turnover crosses 1.5 crores. The turnover crosses 1.5 crores. Before that, what all he has, all those you have to clear. You can claim the input tax credit, provided the credit on capital goods shall be reduced by such percentage points as may be prescribed. Capital goods are subject to depreciation. So when you are purchased a capital goods, say a year back, when you were in the composition scheme, and now you opted for the regular scheme, it is not fair to take the exact GST on the capital goods as the credit because it is a depreciable asset. So for that, percentage points are mentioned. 5 percentage points per quarter is what is mentioned in the rule. So to that extent, the input has to be reduced and the credit can be taken, right? So that is your composition scheme to regular scheme 18.1c. Can transporter levy regular tax instead of composition? Transporter, he can definitely go for the regular tax as well. Transporter has two options. One is 12% with ITC or 5% RCM without ITC, right? So regular tax can definitely be levied by the transporter. There is no problem. Fine. So therefore, an important, and also 18.1c. So an important point you have to remember here is with regard to sharing the screen. Changing the screen is a bit tough. Let me just work myself over it. Yeah. Yeah. So therefore, if you see, one important point you have to note down. Okay. The main difference between 18.1a and 18.1b. Okay, 18.1a and 18.1b. Okay, these two we don't have, and 18.1c, 18.1d is absence of ITC on capital goods for. Okay, so 18.1a and 18.1b, these two don't cover capital goods, whereas 18.1c and 18.1d covers the capital goods, right? That is an important point which you have to remember. Yeah. So now we come back here. So therefore, 18.1d is what exempt supply becomes taxable supply. So 18.1a, 18.1b, 18.1c, I hope is clear now. 18.1d talks about when a supply is exempt and it becomes taxable. There is multiple situations where an exemption is there for any particular product. Later, it becomes a taxable product and GST is applicable on that, right? A simple example is textiles. In the textile industry, it was earlier not subject to tax or just 5%. Later, they increased the rate to 12%. Same way, any exempt supply can become a taxable supply once the GST Council meets and discusses and releases the notification. In this particular situation, where an exempt supply becomes a taxable supply, again, such person can be entitled to the input in respect of inputs held in the stock and inputs held in semi-finished or finished goods held in the stock relating to such exempt supply and on the capital goods exclusively used for such exempt supply. What does this mean? Now, there is an exempt supply. This exempt supply becomes the taxable supply. For the exempt supply, some inputs were there in the stock and inputs were there in the semi-finished or finished goods and in such stock, and later and also capital goods were there with regard to capital goods are there as well with regard to the exempt supply. So later what happens when these supplies become taxable, the credit of the ITC can be claimed with regard to these three items as well. Again, with regard to capital goods, the credit shall be reduced by such percentage points as may be prescribed. Fine. So that is your 18(1)(d) exempt supply. So 18(1)(a) is liable for registration and gets registered. 18(1)(b) is voluntary registration. 18(1)(c) is shifting from composition to regular scheme, and 18(1)(d) is your exempt supply becomes taxable supply. These are the four circumstances which are covered in 18 subsection 1. I hope this is clear. Coming back. 18 subsection 2 prescribes a time limit for claiming the input tax credit under subsection 1. That means what? Now, in these four circumstances which were covered in section 18 subsection 1, it says that whatever stock is there, the input on that can be claimed. But 18 subsection 2 puts a time limit which is applicable for that. That means, in case of any goods or services, input tax credit cannot be claimed after the expiry of 1 year. After the expiry of 1 year from the date of issue of tax invoice relating to such supply. So when there is a tax invoice, okay, and you have procured that input and you are keeping with you, 1 year after the expiry of 1 year, you cannot claim any input tax credit. So therefore, whichever goods are there, the invoice has to be before 1 year. Only then you can claim the respective input tax credit. So that is your 18 subsection 2 time limit. Basically, no ITC after 1 year of issue of invoice. Fine. That is your 18 subsection 2. Now we come to 18 subsection 3. Transfer of unutilized ITC in case of change in constitution. Now, what do you mean by that phrase change in constitution? There is a sale of one business to the other. There is a merger of two companies. There is a demerger of two or more companies. Okay. Or there is a transfer of business with specific provision of transfer of liabilities. In that particular situation, there will be a lot of input tax credit which remains unutilized. There is a lot of input tax credit which remains unutilized. This unutilized input tax credit can be transferred to such merged, demerged, amalgamated or transferred business in such manner as may be prescribed. So in case of change in constitution, okay, whatever input tax credit is there in the credit ledger which is unutilized, it will be transferred to the demerger, amalgamated or new business as may be prescribed. Very simple. Unutilized ITC is there. Change in constitution is happening. You can transfer. How to transfer and all, it is given in the rules. We'll go through that as well. So that is your 18 subsection 3, unutilized input tax credit transferred in case of reconstitution, etc. Now we come to 18 subsection 4. Is a reverse situation what is covered? Is a reverse situation what is covered? That means two situations are covered here. When he is in regular scheme, he opts to pay the tax under section 10. Or when the goods or services supplied by him become wholly exempt, right? It was a taxable supply, later it became an exempt supply. Then what happens? These are the two circumstances which are covered in 18 subsection 4. So when the registered person who has availed of the ITC opts to pay the tax under section 10, or when the taxable supply becomes exempt supply, just as how 18 subsection 1 gave the facility to take the credit, 18 subsection 4 says that he has to pay that amount. He has to pay that amount. That means you have availed the credit and those goods are there with you, and now you are in composition scheme. So therefore that amount is lying in your credit ledger. So that you have to pay by way of debit in the electronic credit or cash ledger, equivalent to the credit of input tax in respect of inputs held in stock, finished or semi-finished goods, and on capital goods reduced by percentage points. For capital goods, percentage points will be applied. On the day immediately preceding the date of exercise of such option, or as the case may be, the date of such exemption. Fine. So whenever he gets transferred from regular scheme to composition scheme, when he exercises that option, a day prior to that, whatever stock is there, on that the input tax we should have to be paid by way of debit in the electronic credit or the electronic cash ledger, or in case of the exempt becomes taxable, in that case he has to pay that amount. I hope this is clear. 18 subsection 4. After you pay that amount, in case there is still any balance in the credit ledger, it shall lapse. That means you will not get any benefit because of that. It will totally get lapsed. That is our 18.4 reverse situation. Reverse situation, that is 18 subsection 4. What does it say? Composition scheme. Composition scheme transferred to regular scheme, or exempt supply becomes taxable supply. This is there in 18 subsection 4. I hope again till now it is clear. Doubt by Mr. Dilip. In section 18.1d, where the goods, one second, voluntary shifting to composition scheme to regular scheme B. Yeah, exempt becomes taxable. Okay. When goods lying in stock is exempt goods when purchased, but late by way of notification, it becomes taxable. So on subsequent supply, ITC can be availed. But technically speaking, government has not received tax during purchase. So it is lost to the government by the process and beneficial to the person claiming. Let me understand. Get this doubt. It's a bit too long a sentence. Let me just again read it. Goods are exempt when purchased but late by way of notification. It becomes taxable. Okay, correct. So therefore, the goods in the stock were exempted. When they purchased, it was exempted. That means it did not pay any input tax. It becomes taxable on subsequent supply. Okay, ITC can be availed. No, see, when there is an exempt goods, it becomes taxable. It becomes taxable. Whatever, the moment it becomes taxable, ITC such be availed. Technically speaking, government has not received the tax during purchase. Yes, you are correct. You are correct. Your government has definitely not received the tax during purchase, but on the sale, the government is receiving. On the sale, the government is receiving. That is why to that extent, input tax benefit also is given. I understand. It's a very, very nice doubt what you have asked. The moment it becomes taxable, when the goods were purchased, at that time tax was not paid. But please bear in mind, that time even on the sale, there is no tax. That time, even on the sale, there is no tax. So therefore, later when it became taxable, on the sale, there is tax. And on the input, there is input tax credit. Differential tax goes to the government. So yesterday's example excluded ITC of 1 lakh GST paid on trucks used for transport of material. Can we take ITC? See here, actually, there was a small miscommunication. The trucks which are used for transport of goods on that input tax credit is eligible. I was going to anyways clarify in today's class, but thanks for getting this to my notice. 17 subsection 5 clearly mentions motor vehicles for transportation of persons having approved capacity of not more than 13. So therefore, motor vehicles for transportation of goods, where the primary object is transportation of goods, the ITC can be taken. So definitely it is allowed. I hope you understood the logic. Yesterday, I think we thought it was not allowed, but it is definitely allowed, because motor vehicles for transportation of persons is clearly mentioned. So 17 subsection 5 first point talks only about the motor vehicles which are used for transport of passengers. It doesn't talk about the motor vehicles used for transportation of goods, which is why the input tax credit is available. I hope it is clear. So that was your 18 subsection 4, which talks about composition to regular and exempt to taxable. 18 subsection 5 is a not residuary section. It's just a section which refers to the rules. It says that whatever credit is there under subsection 1, whatever you are working, and whatever is the amount what you are supposed to pay shall be calculated in the manner as may be prescribed. It is prescribed under the rules which we will discuss now. That is your 18 subsection 5. Okay, amount calculated as per rules. Now we come to 18 subsection 6 is supply of capital goods or plant and machinery. Very, very interesting situation. Now you are procuring a capital goods on which you have taken the input tax credit. Then the registered person shall pay amount equal to ITC as reduced by percentage points or transaction value of such goods determined under section 15, whichever is higher. This basically talks about disposal of capital goods. How do you value and how you have to pay the tax? So therefore, if any capital goods is purchased, in that particular situation, you have to, how do you do it? Let me show an example here. Now, let us take an example here for 18 subsection 6. A purchased a furniture worth rupees 2 lakhs. Okay. GST at the rate of 18% is claimed as credit. So total credit comes to rupees 36,000. Okay. This he has already claimed. Credit is already claimed. Now, this, assuming this happened in the year 2022 January. Now, in February 2023, he sold the furniture for rupees 1,30,000, which is the transaction value. Okay, so what you have to do here is take the ITC. Okay, ITC is rupees 36,000. Okay, reduced by 5% per quarter. Okay, 5% per quarter. So therefore, how many quarters over here? Jan to in 2022 4 quarters, or part thereof also you have to take that as 1 quarter. So 5 quarters are over. So 20% you will reduce. So 36,000 minus 20%. 36,000 minus 20%, which comes to 28,800. Okay, this is first option. Or tax on transaction value, which is 1,30,000 into 18%. 1,30,000 into 18% is rupees 23,400. In this, whichever is higher, 28,800 is higher. This has to be paid to the government. Okay, I hope you understood how this 18 subsection 6 works when a capital goods is transferred or disposed by the person. But there's a small exception which is given in case of refractory bigs, molds, dies, accessories, jigs, fixtures, when they are supplied as scrap. So all these are capital goods only. But when these goods are not sold in regular goods, but they are supplied as a scrap, that means it becomes totally nil. But whatever they are recovering, they will recover. Then there is no question of taking that value and no question of reducing 5% per quarter, but it will be just the value, transaction value, on that the tax has to be paid, right? That is your 18 subsection 6, which speaks about refractory bricks, molds, jigs, etc. Right? That was your 18 subsection 6. I hope this point is clear. Before we go to the rules, let me see if there are any queries. Thank you, sir, for clearing the query. Yeah, it's my pleasure, Viraj. Yeah, coming back. Rule number 40 covers the claiming of credit in special circumstances. The input tax credit claimed in accordance with the provisions of section 18 subsection 1 on the inputs held in stock or finished goods held in stock or capital goods in accordance with clause C and D shall be subject to the following conditions. So therefore, please remember, rule 40 speaks only about the ITC with respect to 18.1c and 18.1d. So what is 18.1c and what is 18.1d? Shifting from composition to regular, 18.1d exempt becomes taxable. These two you have to remember. Only that is only covered under rule number 40. In that case, so therefore, rule number 40 is purely related to the tax on capital goods. That is why 18.1a and 18.1b are not covered. 18.1c and 18.1d are covered. In this case, ITC shall be claimed after reducing the tax paid on such capital goods by 5 percentage points for quarter of a year or part thereof from the date of invoice on which or documents on which capital goods were written. I hope this is clear. 5 percentage points will be applicable in case of 18.1c and 18.1d. Second one. Under 18.1, the registered person shall within 30 days from the date of becoming eligible under 18.1, that means all those 4 situations are covered here, 18.1a, b, c and d, or within such period as may be extended by the commissioner, shall make a declaration electronically on the common portal in form GST ITC 01 to the effect that he is eligible to avail the ITC as aforesaid. What does this mean? In case of the claiming of the ITC in 18 subsection 1 under A or B or C or D on any clause for that matter, he will make a declaration. This registered person will make a declaration electronically on the common portal in form GST ITC 01. GST ITC 01 will make the declaration to the effect that he is eligible to avail the input tax credit as aforesaid. I am eligible to avail the input tax credit. So to this extent, I will make the declaration. This is a procedural formality which the taxpayer has to be done, and this time limit also can be extended. 30 days is the time limit which is given. Within 30 days, this ITC 01 has to be filed. Only then ITC can be claimed. Rule number 40, point number C covers the declaration, the date on which the declaration has to be filed, and what amount, what has to be declared, what has to be clearly given in the declaration. So the declaration under clause B will clearly specify the details of the inputs or inputs in the finished goods or capital goods of what are 18.1a on the day preceding the date in which liable to pay tax, 18.1b day preceding date of grant of registration, 18.1c day preceding the date on which is liable to pay under 9, or on the day 18.1d is preceding date on which supplies become tax. So on these dates, what are all the inputs which are lying? What are all the capital goods which are lying? All these things will be provided in the declaration in ITC 2 to ITC 01, which is to be filed by the registered person. That is your rule number 40. Point number C. Emphasis is also given on certification by a chartered accountant or a cost accountant. In case the details or the aggregate value of claim exceeds rupees 2 lakhs. So see, this is a very, very wonderful facility which is given by the GST department, wherein in these cases, the credit can be transferred on these 4 situations arising. The credit can be transferred in these 4 situations which is arising. This it's a very, very wonderful facility which is given. So therefore, the emphasis is on the taxpayer to make sure that he is declaring the details correctly. The emphasis is very much on the taxpayer to make sure that he is declaring the details very clearly. That is why in this particular situation, if it is more than 2 lakhs, that is the claim of ITC is more than 2 lakhs, the respective details what is given in the declaration has to be duly certified by a practicing chartered accountant or a cost accountant. Very, very clear. Wonderful rule which is given here. Therefore, the value of the certificate also is very, very important. So you as a CA, when you're getting this sort of a certification, you have to make sure that the respective inputs, what all you have to verify? You have to verify the invoices with regard to the inputs which have been procured, whether they are genuine, whether they are appearing in your GSTR2A, all these things have to be very clearly seen. Then the next one, the ITC claimed in accordance with C and D. C and D, what? C is composition to regular, D is exempt to taxable. You should immediately recollect. 18.1, though the section numbers are not required to be remembered, this 18.1 A, B, C, D, it is advisable for you to remember because the way in which you are claiming the tax has to be clearly demarcated. So therefore, in this particular situation, it should be verified with the corresponding details as is given in the GSTR1. As I told you, this you have to clearly verify whatever the ITC is given, whether it is given in the 2A or the 2B. The amount of credit in case of supply of capital goods for the purpose of 18.6. 18.6, what does it say? You purchase the capital goods, you have claimed the input tax credit, and you are selling the capital goods. So how much ITC to be claimed, or rather how much tax is to be paid on the disposal of the capital asset? That is covered in 18 subsection 6. So how to claim the credit? You reduce the input tax at the rate of 5 percentage points from the rate of issue of the invoice. We just did an example on that. I hope you got the clarity. So these are some rules which are given in rule number 40 with regard to the provisions covered in 18 subsection 1 to 18 subsection 6. That was your rule number 40 covering 18 subsection 1 to 18 subsection 6. No further queries. Let us carry on. Now we come to rule number 41. In case of change in constitution, in case of sale, in case of merger, in case of amalgamation, lease or transfer of credit. What does this mean? Here, the registered person shall, in the event of sale, merger, demerger, amalgamation, lease, transfer, multiple cases, sale, merger, demerger, amalgamation, lease or transfer or change in ownership of the business, he will furnish the details of the sale, merger, demerger, etc. in form ITC02 electronically, along with a request for transfer of unutilized credit lying in the electronic ledger transfer. So just because you are reconstituted, it doesn't mean that straight away whatever is there in your, when you were in an old company, it straight away migrates. You have to file one respective form, which is called ITC02. So this ITC02 has to be filed in case of these events electronically with a request for transfer of unutilized ITC lying in the electronic credit ledger. Fine. So this is rule number 41, which talks about 41.1 talks about transfer of ITC. Yeah, next. There is a provision also which is given. In the case of demerger, the ITC shall be apportioned in the ratio of value of assets to of the new units as specified in the demerger scheme. So, what is the value of the total assets which are there? Okay, in that proportion, the ITC shall be apportioned. Because demerger, what will happen? The assets, whatever is there, will be split between two different companies. So, input tax credit also will be split. So, what is the assets gone to each company? By total assets, that will value. So, value of the total assets is the entire assets. It does not matter whether you have claimed the input tax credit or not. Total assets of the business have to be taken into consideration for the purpose of taking this particular input proportion. Then the transferor shall also submit a copy of the certificate issued by the practicing CA, etc. So here, if you see, here also the onus is there on the chartered accountant for this particular point. Here, what happens is copy of certificate issued by practicing CA will be there. Sale transfer has been done with a specific provision for transfer of liabilities. The transferee on the common portal will accept the details, and upon acceptance, what happens is the unutilized credit shall be credited to the electronic credit ledger. Fine. So I hope this point also is clear. Wherein whatever details is given, the transferee shall accept, and the unutilized credit shall be credited to the electronic credit ledger. And whatever inputs and capital goods are transferred will be duly accounted for the by the transfer in the books of accounts. Okay, right. Now we come to rule number 41A. Rule number 41A. Just a moment. Yeah. 41A talks about transfer of credit on obtaining separate registration for multiple places of business. 41A. Transfer of credit on obtaining separate registration for multiple places of business. What is this? First, meanwhile, let me see if you have any queries with regard to till now, so that we look at that and then go forward. Yeah. Now, a situation may arise when there is a purchase which has occurred, and this purchase, the credit gets transferred to multiple GST registrations, because a person who has, and again, registration chapter, we will see this. A person who has multiple business in multiple states, they have to go for a separate GST registration. So whenever separate registration is taken for the multiple states, okay, unutilized input tax credit which is lying, this will get transferred to each particular state, any or all of the newly registered place of business. So whenever the respective input tax credit is transferred, within the 30 days period, details in GSTR ITC 2A has to be submitted. Fine. What does this mean? Let us take an example here. Let us take an example here. Let us go back to the working here. Now, okay, so here what is happening? Mr. A has a registration in New Delhi. Okay, he has procured material for sale in different states. Okay, he wishes to open offices in multiple states. He takes GST registration in Telangana, Tamil Nadu, Karnataka, and Kerala. So that means totally one registration he already has. He has procured material for sale. Let us assume material worth rupees 5 lakhs has been procured. Now, this material needs to be sold at different places. Fine. So therefore, the ITC is 90,000, 18% of that one. Now, this 90,000 can be apportioned to the following states. How? ITC 02. ITC 02 has to be 5 and in proportion of assets of each registration. I hope this is clear. So this is the way the apportionment has to be done in this particular situation. Okay, I hope this is clear. So whatever ITC is there, it will be transferred to the respective states of business. So ITC 2A, he has to indicate, and the ITC in the value of assets means the value of the entire assets of the business. Newly registered person, he will accept the details furnished. Such acceptance, it shall be unutilized credit, shall be credited to the electronic credit ledger. Fine, it shall be credited to the electronic credit ledger, whatever unutilized ITC is there. So that was your rule number 41A. Now we come to the next rule, which is rule number 44. Rule number 44. Manner of reversal of credit under special circumstances. In special circumstances, what does this mean? Now, if you see, there are two circumstances which are covered here. The amount of ITC relating to inputs held in stock, finished goods and capital goods for the purpose of 18 subsection 4. What is 18 subsection 4? We just covered. 18 subsection 4 is composition scheme to regular scheme. Okay, reverse composition scheme to regular scheme. That's what it is. Let's just verify once. 18 subsection 4 is in these particular situations. Once you are in the regular scheme to composition scheme, not this, the regular scheme to composition scheme, and taxable supply to exempt supply. That is what is covered. Now we come back to our rule number 44. Now what does it say? 18 subsection 4 speaks about reversal of credit. Therefore, in these two situations, when you transit from regular to composition, or you transit from taxable to exempt sum, you have to reverse the credit. Reverse the credit. So how that shall be done? The rule is given in rule number 44. Inputs held in stock and inputs contained, it shall be calculated based on the invoices. Very, very clear. Whatever invoices are there, you have taken the credit, now you will reverse it. For capital goods, pro rata basis, ITC will be computed. Useful life of 5 years. Useful life of 5 years. Pro rata basis, useful life of 5 years. So amount under 1 shall be determined separately for ITC of central tax, state tax, with the GST or tax. Very, very clear. Right? So this was the first one where the input tax credit reversal will happen. Now, there may be a situation where the invoices are not available, because here what happens, there is a reversal which is supposed to be done. You are transferring from regular to composition scheme, you don't have the respective invoices that time what is to be done. So when tax invoices are not available, you should estimate the amount based on the prevailing market price of the goods on the effective date of occurrence of the events. So therefore, if invoices are not there, prevailing market price needs to be considered. Prevailing market price needs to be considered. And amount determined under sub-rule 1 shall form part of the output tax liability of the registered person, and the details of the amount shall be furnished in ITC 03. So whatever amount you have determined, it will become an output tax liability, and you have to do it in ITC 03. Fine. Where such amount relates to any event given 18.4, and in GSTR 10, where such amount relates to cancellation of registration. So in case of cancellation of registration, when there is ITC, which you are supposed to reverse, you have to furnish them in GSTR 10. GSTR 10 is your final return post cancellation. Then certification also should be done by chartered accountant or the cost accountant. No monetary limit is given. Certification, unconditional certificate by practicing CA or cost accountant is required. Then same way, it also talks about 18 subsection 6, that capital goods, how to derive. It shall be in the same manner as specified in clause B of rule. That's nothing but that 5 percentage points for each tax, it has to be clearly given. Whatever amount is determined is more than the transaction value, it shall form part of the output tax liability. Same shall be in GSTR 1. So therefore, whatever tax you are paying on the disposal or supply of the capital goods on which input tax credit has already been taken, the same shall be given in form GSTR 1. That was section 18 in a very detailed manner we have covered. Let us just go through the important points before we go to the next. So therefore, to conclude, what all does section 18 provide? Entitlement of ITC on inputs in stock and in finished goods or work in progress, and capital goods also at the time of registration or voluntary registration, at the time of regular tax paying by exiting composition levy, or coming into tax paying status by exempt supply becoming the taxable supply. Entitlement of ITC. Again, stocks, capital goods is there only with respect to 18(1)(c) and 18(1)(d). Okay, that is a very important point. Whereas inputs, input services, therefore 18(1)(a) and 18(1)(b) as well. I hope this point is clear. The next one is reversal of ITC on inputs held in stock. Reversal of ITC of inputs held in stock. Inputs held in reversal of ITC on inputs in stock and in finished goods at the time of exit from regular to composition or taxpayer to exempt. That also is covered here. Then amount payable on supply of capital goods or plant and machinery on which ITC has been taken. Transfer of ITC on account of change in constitution. These are the points which are covered. So therefore, a tabular format for all of you to understand very clearly. The person who is eligible for credit in the first situation is a person who is liable to be registered under GST. So a person who is liable to be registered needs to apply for registration within 30 days from the date on which he becomes liable for registration. He has to apply for registration. And granted, in that case, he can take only inputs in stock and inputs in semi-finished and finished goods. Please bear in mind, capital goods are not covered in this particular situation. And the date is the day immediately preceding the date from which he becomes liable to pay the tax. Right? Then the person who is not required to register but obtains voluntary registration. That means he did not register, but he got himself registration. Then again, inputs in finished, semi-finished goods stock, day preceding the date of registration. Condition, 1 year from the date of issue of tax invoice by the supplier. That means whatever input invoice is there, whatever input is there, you can claim the credit only if it is within 1 year from the date of issue of the invoice by the supplier. Very, very important. Next one, a registered person who ceases to pay the composition and switches to the regular scheme. Composition he stopped, he has changed to regular scheme. Fine. Inputs to stock, semi-finished, capital goods, everything has to be covered. Date when he becomes liable to pay the tax under regular scheme, the day preceding that date, that has to be taken into consideration. Then exempt becomes taxable. This is nothing but 18(1)(c) and D. Exempt taxable supply, exempt supplies become taxable supply. This also same. Day preceding the day on which supplies. What are the restrictions here? Capital goods, 5% per quarter, percentage points has to be taken and reduced from the rate of the invoice. Whatever ITC is claimed will be verified with the corresponding details furnished by the supplier. Then ITC to be availed within 1 year from date of issue of tax invoice. These are the conditions which are given in this particular situation. Further procedures which are there, registered person should make an electronic declaration. It has to be made within 30 days from the date where he becomes eligible to avail the ITC. Within 30 days, he has to file the declaration. And if the claim exceeds 2 lakhs, has to be certified by a CA. Claim exceeds 2 lakhs, claim has to be certified by a CA. Then, example, Mr. Z becomes liable to pay the tax on 1st August and is obtained registration on 15th August. Is Mr. Z eligible to claim credits on inputs and capital goods? Classic case of an example. He becomes liable to pay on 1st August. So within 30 days from the date on which he becomes liable to pay the tax, he has to obtain the registration. He has obtained the registration within 15th August. So is he eligible to claim the credit on the inputs and the capital goods is the question. If you please bear in mind, 18(1)(a), this falls in 18(1)(a), which does not give the credit for capital goods. It gives only for inputs. So therefore, he can claim the credits on inputs. What is the date you have to take? 31st July. That is the date preceding the date on which he is liable to pay the tax has to be taken. 31st July has to be taken into consideration. And registration obtained on 15th August. So 31st July, whatever the inputs, he can claim the credit of that. Capital goods, he cannot claim. Next question. Mr. B, a registered taxable person, was paying tax at composition rate up to 30th July. However, with effect from 31st July, he becomes liable to pay the tax under regular scheme. Comment on the eligibility of ITC for Mr. B. So here, composition scheme to regular scheme. This definitely it gives the benefit even to the capital goods. So therefore, both inputs and capital goods can be taken. Okay, the day preceding the date on which he liable to pay the tax, that is 30th July, whatever inputs are there in the stock in finished or semi-finished goods, as well as the capital goods can be taken into consideration for the purpose of claiming the ITC. Fine. Any queries? If no queries, we will work out a problem based on section 18. Now, let us look at this problem. B&D, a partnership firm in Nagpur, Maharashtra, is a wholesaler of taxable product P and product Q exempted by way of a notification. That means product P is there, product P is taxable, and product Q is exempt. Okay, same question, same type of question we worked out in composition scheme when we discussed charge of GST, but this is a different question. Don't think just because it looks the same, it doesn't mean they are the same, it is different. Now, this firm supplies the products in the eastern part of Maharashtra. All procurements are from suppliers under regular scheme. Okay, they are under the regular scheme. The firm pays tax under composition scheme. Fine. Composition scheme, B&D company has furnished the following company details with respect to the turnover and the stock. So therefore, composition scheme applicable up to 1.5 crores. Okay, so first he is given the turnover for the quarter ended 30th September. Turnover for the quarter ended 30th September. So what is the aggregate turnover for till now? That is for the quarter ended 30th September is given. For quarter ended 30th June also he has given. So that means from April to September, what is the turnover? Is 60 lakhs plus 50 lakhs plus 17 lakhs 65,000 plus 17 lakhs. So total turnover up to 30th September, total turnover up to 30th September is 1 crore. Okay, total turnover up to 30th September is rupees 1 crore 44 lakhs 65,000. This is the total turnover. Now, he has also given the details of stock as on 30th June, as on 30th September, or 31st October. So why are these details relevant for us? Because stock on the day preceding the date on which he becomes liable to pay the tax under the regular scheme, those particular stocks input tax credit can be claimed. That is why this is very important for us. Let us go to further details. The entire stock of product P and Q available with the firm as on 30th September is purchased during the said half year. That is nothing but April to September, except a consignment of product P, which is purchased in April month of the preceding financial. So that means apart from one particular item, all the items were procured in between April to September. One product P, that is 3 lakhs purchased in April month of preceding financial year. Why is this given? Because this product P was purchased more than 1 year before. Since it is more than 1 year, on this P, if any input is there, you cannot claim. That is why this line is given. The said stock could not be sold during the month of October. In the current financial year, in the month of October, no purchases were made and products were shown with a profit margin of 20% of sales. So therefore, whatever amount is given here is basically after adding profit margin of 20%. So extract of bill book gives the following details. All these bills are given. Value of the product also is given. Then same way here also it is given with multiple dates which are given. So what all you have to do? You have to first calculate the ITC which is credited to the electronic credit ledger when it exits the composition scheme and becomes liable to pay the tax under the regular scheme. Please try to work out this problem first, then we will discuss the solution. I hope all the details are captured. Waiting for some answers. Hope you are trying to answer this question, everyone. Here, first thing you have to calculate the turnover, and then work out the input. Yeah. So therefore, if you see here, 1,44,65,000 is the turnover till September. As you know, aggregate turnover includes the taxable supply and the exempt supply also. So therefore, taxable supply, exempt supply put together comes to 1,44,65,000. Once this amount comes, the next page, if you see, it gives you the sales. So 1,44,65,000. 1,44,65,000. Add 2,03,000 to that. Add 138,250 and add 106,250. 92,500. That means here at this stage on 3rd October, the total turnover is crossing 1.5 crores. Therefore, 3rd October is in. So therefore, what is the date on which you can claim the inputs? The day preceding the date on which he is liable for the regular scheme. So therefore, on 3rd October, that means 2nd October is what you have to take into consideration. Fine. 2nd October is what you have to take into consideration for calculating the inputs. Fine. For calculating the inputs. Now, if you see, he has given the inputs data of 31st October, which is not very relevant for us. 30th November, 30th September also he has given. And if you see, he has also said that one is purchased before 1 year. So that also you have to see. Then products were sold with a profit margin of 20% of sales. So whatever sales is given, he has given the profit margin. With this, we can extract the respective cost of the product. That is what we have to do here. So first things first, let us calculate the credit. So first thing, if you see here, stock of taxable inputs as on 30th September. On 30th September, it is on 30th September, 1 second. If you see here, wholesaler of taxable product P and product Q. Product P only is important because Q is exempt. So there is no question here. Here we are looking at a composition to regular scheme conversion. So therefore, stock on 30th September of taxable product P, 10 lakhs is to be taken into consideration. So therefore, here if you see, the stock of taxable inputs on 30th September is 10 lakhs. Is 10 lakhs. Okay. Then, were there any purchases? Any data of purchases is given here between those particular dates? Nothing is given. There is no purchases here at any cost. There is nothing is given here. Only sales are given with the bill books. So therefore, purchases are nil. Then you have to see the cost of taxable goods which are sold between the 1st to 2nd October. As I told you very, very clearly. 2nd October is the date on which you have to take the inputs. 2nd October. Why? Because 3rd October it is crossing 1,50,00,000. It's becoming 1,50,00,000, 5,000 on 3rd October. So before 3rd October, that is 2nd October, whatever is the stock, that has to be taken into consideration here. So if you see already on 30th September, 10 lakhs is given. So therefore, you have to see the sales of product P which is made. That is 2 lakhs plus 1,33,000 plus 67,000. These are the sales which have been made of product number P. So therefore, 2 lakhs plus 1 lakh 33 plus 67,000. 2 lakhs plus 1 lakh 33,000 plus 67,000. 2 lakhs plus 1 lakh 33,000 plus 65,000. This is product number P into 80%, because 20% profit in margin. 3,20,000 is the cost of taxable goods which are sold. So whatever is the stock of 10 lakhs, out of this he has sold 3,20,000 worth goods. So 10 lakhs minus 3,20,000, whatever he has cost of capital goods, you will get 6,80,000, which is nothing but stock on taxable inputs. Okay, so no sale are missing because all the invoices, if you see, invoices are all given in serial order. That means nothing is being missed out. Okay, just to be on the safer side, 6,80,000 is stock of inputs. Out of this, one is more than 1 year stock. If you see here, this 3 lakhs was there in April preceding financial year. So that means this is more than 12 months. So this 3 lakhs also will get reduced from 6,80,000. Balance will be 3,80,000. So ITC will be 34,200 and 34,200. This is the ITC which we can claim. In this question, there is no capital goods. So therefore, straight away ITC has to be claimed. There is no question of 5% per quarter. Fine. So that was your problem, a comprehensive problem based on section 18. Definitely you can expect the same in the examination. Now we come to the next one. Section 18 subsection 4, again further revision with regard to reversal of ITC from regular scheme to composition scheme, or from taxable goods to exempt goods. So whenever ITC has been availed, if the same person is switching to the composition levy, or when his supplies gets totally exempted from tax, then this ITC has to be reversed proportionately on the basis of corresponding invoices on which credit has been availed on such inputs. Right? So therefore, here what is happening? ITC on invoices is reversed proportionately on the basis of the corresponding invoices. Invoices are not available, you have to take the market price of the goods. Again, details have to be certified by a practicing chartered. Same thing here. Whatever ITC is availed with regard to capital goods, you have to reverse on a pro rata basis, and you have to take the useful life at 5 years. 5 years useful life you have to take. Whatever registered person, he will debit the electronic credit or cash ledger by the reversal amount in that on the day preceding the date of switchover or date of exemption. Whatever balance is there in electronic credit ledger will lapse. You have to use it to some extent, and then you have to lapse it. Even if you are cancelling your GST registration, in that case also, whatever ITC which is there on plant and machinery, capital goods, stock, semi-finished goods, etc., you have to reverse the respective ITC. The amount to be reversed is calculated in the manner as given under 18.4 and 6, is then compared to the output tax payable, and higher of the two amounts is finally paid by the registered person. Whatever you are reversing plus the transaction value, whichever is higher, they are added to the output tax liability of the said person. So therefore, as I told you here, if capital goods are purchased on which ITC has been undertaken, which is supplied outward by the registered person, he should pay the amount that is higher of the following: ITC taken on the goods as reduced by 5% per quarter, or tax on the transaction value, whichever is higher. Refractory in the bricks, molds, jigs, fixtures, etc., it is stated that the tax is to be paid on transaction value. Change in constitution of registered person is there in 18.3, read with rule number 41 of the CGST rules. In case of sale, merger, demerger, amalgamation, transfer of change in ownership, remains unutilized in the electronic credit ledger, transferred to the entity. Fine. This also is an important rule which you have to remember. Transfer of change in ownership also includes due to death of sole proprietor. If there is any change in ownership which has happened, that also is covered here. Then demerger, in case of this, the ITC will be apportioned in the ratio of value of the assets of the new units. Okay, same formula will be applicable. Entire assets will be taken into consideration when in this particular situation you are calculating the ITC. Registered person should furnish in ITC 02 on the common portal. Certificate from CA has to be given. Once the transferee accepts those details, the unutilized input tax credit gets credited to the credit ledger. Fine. These are all the respective rules which are given. Went through it. We are just summarizing it once again. For business reorganization, the valuation of the assets has to be taken at the state level only and not at all India level. So different companies are there in different states. Each state, what is the total assets, that only has to be taken. ITC 02 has to be filed by the transfer. Then rule number 41, section 18.3, read with rule number 41, transfer of ITC. Example of here, if you see here, a company XYZ is registered in 2 states of MP and UP. Total value of the assets is 100 crores. Assets in the state of MP and UP are 60 and 40 crores. It demerges part of its business to ABC. As a part of the demerger, assets of XYZ amounting to 30 crores are transferred to ABC in the state of MP, while assets amounting to 10 crores are transferred to ABC in the state of UP. All India level, 40 crores are being transferred. So in this case, for calculating the respective ITC, you have to take the state level turnover only into consideration and work out the ITC which are supposed to be transferred. Then whatever value of the assets is there, you should apply the same to the total of unutilized ITC of the transferor. It need not be applied separately, and it shall be applicable for apportionment of the cess. The total amount of ITC to be transferred shall not exceed the amount of ITC to be transferred, right? So therefore, these are some rules with regard to change in constitution. Apportionment formula shall be applied the date of filing of the ITC 02. The ratio of value of the assets on appointed date of demerger is significant for us. Let us work out one problem now. On 25th August, Messrs. Agarwal and Agarwal, registered supplier of taxable goods located in Bangalore, Karnataka, purchased one machine for rupees 12,39,000, including IGST, from one supplier of Maharashtra who issued the invoice on the same date. Messrs. Agarwal and Agarwal put the machinery to use on the same day and availed ITC for the eligible amount. They also used the machine in process of manufacture of taxable goods. However, Messrs. Agarwal and Agarwal sold this machine to Suresh Kumar of Andhra Pradesh on 20th of August of next year for rupees 7,50,000 excluding GST. With reference to 18.6, determine the amount payable, if any, by Messrs. Agarwal and Agarwal at the time of sale of machine. Applicable rate is 18%. A problem based on 18 subsection 6, which you are going to check regarding the capital goods. How much is the amount which is subject to be paid? We have to do as per this. Please try to work out this problem. So therefore, here if you see, he is purchasing one machine for 12,39,000 who issued the invoice on the same date. So 25th August he is purchasing for 12,39,000. Okay, 25th August, he is purchasing for 12,39,000. 25th August, he is purchased for 12,39,000. Okay, 1 minute. So it says in the problem, including IGST at the rate of 18%. So therefore, 12,39,000 into 18 by 118. Why? Because IGST is already included in this. 12,39,000 into 18 divided by 118 is 1,89,000 is the GST credit at that point of time, which was taken on 25th of August. Then he sold the machine of 20th August of next year. Okay, sold machine on 20th August of next year at rupees 7,50,000. So GST, this is nothing but the transaction value. So GST at the rate of 18% is rupees 7,50,000 into 18% is 1,35,000. 1,39,000. So therefore, now what happened? ITC to be reduced by 5 percentage points per quarter. 5 percentage points per quarter. Okay. 5 percentage points per quarter. So totally how many quarters were there? So he purchased it on 25th August. So therefore, in that particular last year, July, August, September, 1 quarter, part thereof also has to be taken as a quarter. So July, August, September last year, October, November, December, that is 2 quarters of last year. 2 quarters of last year. April, May, June, 1 quarter, July, August, September, October, November, December. He purchased it on 25th August. 25th August. And also January, February, March, if you look at the financial year. So therefore, in previous year, totally July, August, September, October, November, December, January, February, March. 3 quarters were there. 5% per quarter, which is 15%. Which is 15%. So we have to 1,89,000. 1,89,000 into 15%, which comes to rupees 28,350 has to be reduced. Then current year also, he sold it on 20th August. That is April, May, June, April, May, June, July, August, September. 2 quarters because he sold it in August. 2 quarters. Okay. 2 quarters. That is 5% per quarter. 10%. Okay. 1,89,000 into 10%. Into, I'm sorry, 1,89,000 into 10%, which comes to rupees 18,900. This also has to be reduced. So therefore, from 1,89,000, the above has to be reduced. Have to be reduced. So 1,89,000 minus 28,350 minus 18,900. So 141,750 is basically has to be taken into consideration, or 1,35,000, whichever is higher. Okay, this is A and this is B. Therefore, A or B, whichever is higher. rupees 1,41,750 is added to output tax liability. Okay, I hope this problem is clear. You can definitely expect such problems in the examination. So therefore, if you see here, 1,41,750 is a payable. That is why amount of 1,41,750 at the time of sale of machinery has to be paid by Messrs. Agarwal and Agarwal. Fine. This problem, we'll come back to this later. This is based on rule number 43, 42 and 43. Now let us go to section 20, which talks about manner of distribution of credit by ISD. Now, as I told you, what is an input service distributor? Input service distributor comes into the picture when there are multiple offices of the company or the business or the taxpayer, and a common credit is there, which has to be distributed across all the states or across all the offices of the taxpayer. That is what section 20 does. Section 20 talks about the manner of distribution of credit by input service distributor. In this particular situation, how should the input tax credit be distributed to the supplier of goods or services, or both of the same entity having the same tax? This is what is given. 20 subsection 1, the input service distributor shall distribute the credit of central tax as central or integrated tax. So whatever is central tax, the ISD can distribute it either as central tax or integrated tax. That means if there is a CGST, he can distribute it as CGST or IGST. If there is integrated tax, he can distribute it as integrated tax or central tax by way of a document containing the amount of ITC being distributed in such manner as may be prescribed. So this was your input service distributor, 20 subsection 1, how to distribute the respective input. This ISD is to be distributed subject to the following conditions. Credit to be distributed to the recipient based on such document containing such details as may be prescribed. Therefore, if any document is there, that is the invoice. So how do you I'm sorry, I forgot to share the screen. Yeah, sorry. This is your ISD. So therefore, whatever is the document containing such details, based on that, the credit is to be distributed. Whatever amount is to be distributed should not exceed the total amount to be distributed. Then credit of tax on input services shall be distributed only to that recipient. Fine. So any attributable, if you are directly attributable input tax credit to any recipient of credit, you will distribute that to that particular recipient only. Also some conditions. If the credit of input service, tax on input service, is attributable to more than one recipient, it shall be distributed based on pro rata on the basis of turnover during the relevant period. Right? During relevant period means usually that particular tax period, that is per month. Whatever is the turnover which is achieved by the respective registration, where the state where the registration is there, on that proportion it has to be distributed. So what is the relevant period? That is also given as an explanation to section 20. Relevant period shall be if the recipients of credit have turnover in their states or union territories in the financial year preceding the year during which the credit is to be distributed, the said financial year. Do not have any turnover, last quarter has to be taken into consideration previous to the month. So either last year turnover, if last year turnover not there, previous quarter turnover needs to be taken into consideration. Then recipient of credit means the supplier of goods or services or both having the same PAN number as that of the input service distributor. This is the recipient of credit, supplier of goods or services having the same PAN number. That is also clarified. Sometimes the ISD distributes the credit in contravention of the provisions contained in section 20, due to which excess distribution happens to one or more recipients. So whenever excess distribution happens, the credit has to be recovered from the recipient of the credit along with the interest. According to that, 73 or 74 calculating of interest will be recovered from the respective state where the registration is there. Why the ISD concept came into the picture? Because it was there in service tax also. It is not something new which has come in GST only. Wherever the companies have their head office and the units at other places which may be registered separately, the head office will be procuring some services which should be for the common utilization. Since common expenses is meant for the business of all units, it is but natural that credit of input services should be apportioned between the consuming units. So ISD mechanism enables proportionate distribution of credit. This is what is the most important thing. Proportionate distribution of credit is enabled by the ISD mechanism, and the concept of ISD is nothing but a legacy carried on from the service tax. That means it is not something which is new or which is something which is very recent, and the GST is right there from the service tax. That is why the word service also still continues to exist. For an ISD, a separate GST registration is required. That means usually what happens, the ISD registration is always taken by the head office only. So the head office already has a GST registration for itself. For the ISD, it takes a separate GST registration. Separate GST registration is required. Since the services related to other locations, corresponding credit should be transferred to such locations as the output services are provided there. Simple example is a broadband internet connection is taken by the taxpayer. Head office engages the service of a contractor which provides the services to different states. In the proportion of the turnover of each state, it will be divided. Arithmetical accuracy is required, and the credit distributed should not exceed the credit available. Rules are credit to be distributed only to the recipient to which is attributable. More than one recipient, it is to be distributed on the basis of turnover. Fine. Then a problem based on ISD. ABC Limited, a confectionery manufacturer, has paid bills of an advertisement company amounting to rupees 24 lakhs for advertising campaigns for two varieties of cakes which are manufactured at separate locations in Pune and Bangalore. The company had a total turnover of 112 crores in the previous financial year. Turnover of the Pune unit was 5 crores. Bangalore unit was 10 crores. Please compute the ITC which is attributable. Please try to solve this problem. Yeah. So therefore, here what is happening? Confectionery manufacturer, bills of advertising company of 24 lakhs. Total turnover was 112 crores in the preceding financial year. Turnover at Pune was 5 crores. Turnover of Bangalore was 10 crores. Aggregate turnover is 15 crores. So therefore, total turnover of 112 crores. So therefore, 24 lakhs is the bill. Amounting for 24 lakhs here is the respective bill. Locations of Pune and Bangalore separately. So here if you see, only Pune and Bangalore are relevant for us, because in this particular situation, the previous turnover is not relevant here, because he is also already given the turnover So aggregate turnover is there here. So therefore 1:2, that is Bangalore is 10 crores, Pune is 5 crores. So according to that, in 1:2 ratio, that is 24 lakhs, 8 lakhs will be given to the Pune unit and 16 lakhs will be given to the Bangalore unit. So therefore here turnover of Pune 5 crores, turnover of the Bangalore unit 10 crores. This is what is important here for giving the ITC credit. Relevant date is not mentioned here. We are assuming that this is the relevant date which is given. Method of distribution of taxes, ITC of CGST, SGST, UTGST is distributed like this. CGST, SGST, UTGST is distributed as IGST, and IGST is distributed as IGST. Fine. Before we go to this problem, let us take a short break of 10 to 12 minutes, and then we'll come back. Once we are back, we will revise the ISD concept with some problems, and then we'll work out some multiple problems based on all the concepts what we have declared in this particular topic. See you in the next 10 minutes. Yeah. So let us work out a few problems and case studies based on the uh, topic of the IT input tax credit, what we have discussed now. First problem, Xenon Private Limited Agra is a registered supplier engaged in the manufacture of taxable goods. Goods valued at rupees 10 lakhs 50,000 were supplied by the company to Fresh Bite Private Limited, a registered supplier located at Ferozabad, without the cover of an invoice with fraudulent intent. Since the company evaded tax by not issuing the invoice for the supply, a show cause notice was issued by the proper officer under section 74, requiring the company to pay tax at the rate of 12%. That is rupees 1,26,000, which is nothing but 10,50,000 into 12%, an applicable interest and penalty. The company paid tax, interest, and penalty after the order was passed by the proper officer. Examine the ITC entitlement of Fresh Bite Private Limited in respect of 1,26,000 paid by Xenon Private Limited. Try to answer this. One query, sir, as if payment for invoice is not made within 180 days, the availed ITC is to be reversed. What if a supplier has given a credit period of more than 180 days? His recipient still have to reverse ITC. 100% they have to reverse. Credit period of 180 days, if someone is given, he will be the most successful businessman when it comes to turnover as per GST returns. But I don't know when he'll get the amount. The 6 months credit period is very huge. 100% it has to be reversed because 180 days time limit is a statutory time limit as per the GST. It doesn't matter on the number of months which is being given as a credit period. It has nothing to do with the number of months. So therefore, it's not related in any way. So 100% you will have to reverse the ITC. So therefore, here what is happening is, with regard to this question, the amount of tax was not paid, right? Therefore, later it was paid only after an order was passed. If you see here, show cause notice was issued requiring then only the company paid the tax. 17 subsection 5, which talks about the block credits, clearly mentions that in case of any tax which is paid in pursuance of the order, where the demand is confirmed on account of fraud, willful misstatement, or suppression of facts, you cannot claim the same as the ITC. So that is what is has to be done here. As per 17 subsection 5, tax which is paid under 74, 129, and 130, these three sections you will see in penalties and prosecution and offences and penalties chapter, is not availed as ITC. Further, Rule 36.3 also says that the tax paid in pursuance of the order where the demand has been confirmed on account of fraud, willful misstatement, or suppression of facts cannot be availed as the ITC. Therefore, here, since Xenon has paid the tax in pursuance of the order issued under section 74, therefore it cannot avail the input tax credit, right? I hope this point is clear. Now we go to the next problem. Please go through the second problem. Flamingo Limited is an airlines providing passenger transportation services by air. The company offers meal of premium quality to passengers on board the aircraft. The value of such meals is compulsorily included in the price of the air ticket. The company avails outdoor catering services of Daniyaram Private Limited for providing such meals to its customers. Examine whether Flamingo can avail the input tax credit on such outdoor catering service availed by it. Please try to answer this question. So therefore, it's a very, very interesting question. Here, what is happening? The person who is providing the supply, that is Flamingo Limited, is an airline which is providing the passenger transport services. The company offers meals of premium quality to passengers on board the aircraft. So if you see here, there are two services which are being provided. One is passenger transportation services, and second is the meals services to the passengers. So the next question is whether this particular supply, since there are two supplies involved here, whether this is a mixed supply or a composite supply. Okay, that is the first decision what you have to take. So therefore, here if you see, when is it a composite supply? When out of two or more supplies, either one is a principal supply, then it is a composite supply. And the rate which is applicable to the principal supply only has to be taken into consideration when you are working out the tax. So therefore, since here the principal supply is the supply of passenger transportation services, the supply of catering services to the passengers, that is the supply of food meals to the passengers, is a supply which is auxiliary to the main supply. So therefore, first point is it is a composite supply. That is the first thing which you have to remember. Value of such meals is compulsorily included. Outdoor catering services is given as a line item in section 17 subsection 5 for blocked credits. But do you think then whatever the company which avails the outdoor catering services of Daniyaram, that is, it pays the amount for the purpose of procuring the food in the catering services for providing the meals, whether it is allowed? Though it may appear it is not allowed as a blocked credit, if you see 17 subsection 5 has a provision. Let us look at the provision to understand this particular point. 17 subsection 5 has one provision here which is mentioned. What is that provision? There is a condition given with regard to this blocked credit. If you see here, food and beverages outdoor catering is clearly mentioned here. But there is a provision which says that input tax credit in respect of goods shall be available where an inward supply of such goods is used for making an outward supply of the same category of the goods or both as an element of taxable composite or mixer. So that is exactly the same which is happening here. These outdoor catering services, though it is a blocked credit in usual course, here it is being used as a part of the taxable composite supply. Since it is being used as a part of the taxable composite supply, what is a taxable composite supply? Passenger transportation services. Therefore, in this particular situation, even though it is outdoor catering, the input tax credit is allowed. The input tax credit is allowed. So, I think one ISD problem we had to work out. We'll come back to it after we finish this particular problem. Okay. Yeah. So therefore, in this particular situation, if you see outdoor catering services, Flamingo can definitely avail the input tax credit because it is part of the composite supply which is being provided by Flamingo Limited. Composite supply wherein two services are there. One is your passenger transportation services, and the second is your outdoor catering services. It is a composite supply. because the principal supply is passenger transportation services. So since it is a part of the taxable composite supply, therefore in this particular situation, we are taking this into account and claiming the respective input tax credit. Okay, now we come to the next question. Jumbo Sales Private Limited, a supplier of ready-made garments, announced buy one get two free offer on men's t-shirts on Diwali to boost its sale. You are required to advise the company on availability of ITC in respect of inward supplies. Buy one get one free offer. What is the impact of ITC? That is the question. So here what is happening? Buy one get two free offer. We have discussed this point very clearly. Whenever there is a buy one get one free offer or a buy one get two free offer, it doesn't mean that any particular product is being given free of cost to the customer. If the cost of one shirt is 500 rupees, I'm giving one shirt free when you buy the other shirt. Effectively, I'm selling both the shirts at 250 rupees each. This is the meaning of that. So therefore, in 17 subsection 5, there is a particular clause which says that goods distributed as free samples, ITC relevant to that is not allowed. But is it a free sample? Is it given free of cost? No, it is given at discounted cost. Where I'm giving 1 plus 1, that means each shirt price I'm reduced by 50% to that effect. Therefore, applicability of ITC in respect of such inward supply is definitely eligible. There is no doubt about that. So therefore, whenever buy one get one free offer also is there, the respective ITC is very much available, because it doesn't mean that it is being given free of cost. So ITC is definitely available with regard to this particular point. Circular 9211/2019 has clarified sales promotion scheme like buy one get one offer are not individual supplies, but it is a case of one or more supplies where single price is being charged. So therefore, the taxability will depend on whether supply is composite or mixed. So ITC will definitely be available. So therefore, this is not an individual supply of free goods, but it is a case of three individual supplies, three shirts. That is buy one get two means totally three shirts where price what is charged is being reduced. So therefore, definitely our input tax credit will be eligible for this particular point. Okay, now we come back to the next question. So I hope these two are clear. Now we come to the next question. A garment factory receives a Government of India order for making uniforms for a commando unit. The supply is exempt from tax under special notification. The fabric is separately procured. The fabric is separately procured for the supply, but thread and lining material for the collars are the ones which are used for other taxable products of the factory. Okay, so that means what? Making uniforms is exempt supply. Fabric is procured exclusively for exempt supply. So rule number 42, the fabric exclusively for exempt supply means you cannot claim any input tax credit. Thread and lining items are used for other taxable products also. That is, for collars, whichever thread and lining is being procured, they are a common input which are being used for both the taxable and exempt. Turnover also is given. The turnover of other products is rupees 4 crore and 1 crore respectively. That is, other products is 4 crores, exempt product is 1 crore. ITC on thread and lining material procured is 5,000 and 15,000 respectively. Calculate the eligible ITC on thread and lining material. Please try to answer this. Any answers? Yeah. ITC on thread and lining material. Here, if you see, rule number 42 clearly says that exclusively used for exempt supply, credit not eligible. Exclusively used for exempt and taxable, then it's a common credit. Then you have to bifurcate it based on the turnover. This is what it says. So therefore, here the thread and lining material are the inputs which are used for making both the taxable as well as the exempt supply. Therefore, credit will be apportioned on the basis of rule number 40. So credit attributable to exempt supplies is common credit into exempt turnover by total turnover. So in this case, what is the a common credit here? Common credit is turnover of other products is 4 crores, exempt products is 1 crore. ITC on thread and lining material. Here, fabric is exclusive for exempt, not considered. So threading liability 5,000 and 15,000 respectively. So therefore, the total common credit is 15,000 plus 5,000. So if you see here, the total credit which is attributable is 20,000 is the common credit. Exempt turnover is 1 crore and total turnover is 5 crores. 1 plus 4, 5 crores. So 20,000 is the common credit into exempt by total turnover is 4,000 rupees is the credit attributable to exempt supply. So how it works is, first you will take the credit as 20,000, later ineligible credit you will reverse 4,000 rupees. So therefore, the net eligible credit is 16,000 rupees. So this is basically your 16,000 rupees is your net eligible credit. Next question. A registered supplier of taxable goods supplied the goods valued at rupees 2,24,000, inclusive of GST at 12,000 and SGST of 12,000 to Mohan Limited under forward charge on 15th August, for which tax invoice was also issued on the same date. The inputs were received by Mohan Limited on 15th August. Mohan Limited availed credit of 24,000 on 20th September by filing form GSTR 3B for August. However, Mohan Limited did not make any payment towards such supply along with the tax thereon to the supplier. Is he eligible to avail the ITC? Discuss the ITC provisions if he makes the payment of 2,24,000 to supplier on 18th March of the next calendar year. So this problem is based on the concept of making the payment within 180 days from the date of the invoice. So what is how this case has to be treated is what we have to try to answer. Please try this. 16,000. Good. Sham, you got the answer correct. Just some basic problems till we go to some more advanced level problems. So what we'll be doing in today's session is working out some problems. Next session we'll work out, it will be totally problems and case studies. With maybe some 2-3 theory topics are left out. We'll cover that totally, it will be problems and case studies. And then after that, the session on Tuesday will be again further problems and also job work provisions. And also, if time permits, the amendments which are made, which are applicable for your exam in chapters, earlier chapters what we cover. So therefore here, if you see, the invoice when it is provided is taken, right? So when you are availing the credit, the payment of tax to the payment of tax to the respective supplier is not any condition which is required. But there is a condition which says that the payment to the supplier should be made within 180 days from the date of issue of the invoice. But in case they fail to do so, ITC of rupees 24,000 here will be added. How it will be added? Here, if you see here, the total value is 2,24,000 under forward charge mechanism. So Mohan Limited is procuring the product for which tax invoice also is issued. It is issued and credit is claimed of rupees 24,000, right? However, they did not make any payment. So therefore, if the payment is not gone within 180 days, what happens is the respective credit will be reversed. So that means here in this particular situation, since the payment was not being made, that respective credit will be added to the output tax liability of Mr. Mohan. That is the impact because of this one. So now if you see here, 1 minute. Here Mohan, he has to pay rupees 24,000. Okay. 15th August, tax invoice. Tax invoice was issued on 15th August. So therefore, 180 days time limit is there. Is there for Mohan to pay the respective amount to the supplier. So therefore, if you see from 15th August, if you look at 180 days, then approximately 16 days in August, 30 days in September, 31 in October, 30th in November, 31 in December, 31 in Jan, 11 in February. February 11th, 180 days time period gets over on February 11th. So therefore, in the question, if you see, the payment was made when? Payment was made on, did not make any payment, availed credit on 20th September. If he makes the payment on 18th March, on March 18th. So therefore, what has to be done? In February, the amount of credit claim will be added to output tax liability of Mr. Mohan. Okay. And when payment is made on March 18, the amount will be reclaimed as input tax credit in the GSTR EB of for March month, right? This is basically the answer to this particular question. I hope you got the point. Interest also will be applicable initially when it is added. Interest at the rate of 1.5% per month will be applied. What supplier should do to get the benefit of this provision? I didn't understand this question. What supplier should do to get the benefit of the provision of this 180 days provision? See, there is no benefit as such. If he makes the payment within 180 days, he gets the credit. If he doesn't make the payment within 180 days, he doesn't get the credit. Is that what your question was? Kindly expand your question, Viraj, so that I understand what exactly you're asking, and then I'll again check your question. Okay, now we come to the next question. So this is the solution for this. Payment of value of the goods along with the tax is not a prerequisite at the time of trade, but Mohan has to pay the said amount within 180 days from the date of issue of invoice. If he fails to do so, the ITC of 24,000 will be added to his output tax liability with interest. 18% per annum means 1.5% per month from the date of availing the credit till the date when it's added to the output tax liability is paid. If he makes the payment of 2,24,000 to supplier on 18th March of the calendar year, that is after expiry of 180 days, he can avail the credit of 24,000 while filing the GST R3B for the month of March. Then let us look at some cases with regard to 17 subsection 5. With reference to the provisions of section 17, examine the availability of ITC in the following independent cases. First one, MBF, an automobile company, has availed works contract service for construction of foundation on which machinery is used to be used in the production process is to be mounted permanently. Please try to answer this. Sir, for calculating 180 days limit, date of invoice also is included. Yeah, within 180 days from the date of invoice. So technically date of invoice is not included. Within 180 days from the date of issue of invoice. So the days counting will start from the next day. The word used is within 180 days. So here in the first question, if you see, it says that works contract service for construction of a foundation on which a machinery is to be used is mounted permanently. So here I must draw your attention once again to 17 subsection 5. Here, if you see, what does it say here? This 17 subsection 5 clause C is what we have to look at here. Works contract service when supplied for construction of immovable property other than plant and machinery, except when it is an input service or further this thing. So that means here if you see, when supplied for construction of immovable other than plant and machinery, that means plant and machinery is covered. So whether our question falls in the definition of plant and machinery or not, we have to go to the definition. See here somewhere the definition was covered. Yeah, here explanation. Plant and machinery means Apparatus, equipment, and machinery fixed to earth by foundation or structural support that are used for outward supply and include such foundation. So therefore, the main point is here fixed to earth by foundation or structural support is what we have to take into account. So if you go back to our question, what does it say? It says MPF has availed works contract for construction of the foundation on which machinery is mounted permanently. That means it's very, very clear that it is affixed to the earth. Structural support affixed to the earth, mounted permanently. That means definitely it comes in the definition, in the explanation of plant and machinery. Therefore, the credit will be very much available. That is the first point. Second one, Shah and Constructions procured cement, paint, iron rods, and services of architects and interior designers for construction of commercial complex to its client. Please try to answer this. Fine. Any answers for the second one? Now, Viraj, to get the payment in time from customer, Mohan Limited has delayed the payment beyond 180 days. What supplier to do? Supplier filed GSTR 1, by which Mohan got credit in 2B. In such circumstances, supplier start financially 100%. Hence, I asked, what supplier should do to not allow Mohan Limited get the credit unless the customer paid the invoice amount? Very good question. See here, one thing you have to remember is the time of supply provisions. First thing in GST, please remember one. The trigger for paying the GST, you have to pay the GST, right? It does not depend on whether the recipient pays you or not. First question, first point to understand. It is secondary. The recipient will pay you and you pay the government. This is not how GST works. Time of supply, please refer. Date of invoice is the most important thing. So if you want to avoid it, what do? Change the date of the invoice. But there again, multiple things are there. If it is products, the products are already gone there. Again, trigger for time of supply is started. Service is there. You already provided the service. There also trigger is completed. There is no way you can avoid the payment of GST. If this fellow has delayed beyond 180 days, there is no thing you can do. It's very unfortunate, but that is the fact. Fine. So therefore, what supplier filed GSTR 1 credit in such circumstances start finance. Hence, I asked what should not do to not allow get the credit. Unfortunately, that is not the case. The conditions, maybe this fellow should not give him an invoice. Till he receives some payment, he should not give an invoice. You say you first pay the advance amount. Only then I will give you the invoice. Because if he is not in possession of the invoice, he will not get the credit. Those are some measures this person can adopt for somehow avoiding this. But unfortunately, the rule is like that. It totally credit is allowed, but the payment, even though it is not given, you have to make the payment to the GST department. Fine. I hope that is clear. Now we come back to our question. So here, if you see, Shah Constructions procured cement, paint, iron rods, architects, and interior. That means you are procuring the services for construction of commercial contract. Again, let us go back to 17 subsection 5. I want you to see the particular clause so that you understand how it is covered. Goods or services or both received for construction on his own account, including when for furtherance of the business. This is there. But again, this is on the own account. If you see here, works contract service when supplied for construction, except when it is an input service for further supply of the works contract service. There, if you come here, this is an inward supply for further works contract. This is an inward supply for further works contract. That is precisely why it is allowed as the ITC. So therefore, in this particular situation, the Shah Constructions is into works contract. They have procured the related construction services for architects, interior designers. Similar service, inward supply works contract, outward supply works contract, ITC is available. Next one. ABC Limited availed maintenance and repair services from Jaggi Motors for a truck used in transportation of finished goods. Try to answer this. Yeah. So therefore, if you see here again, as we discussed in today's session, someone asked regarding the transportation of goods. When you are looking at motor vehicles, the terminology what is used. Let us go to the section once again, because the wording is very important here. If you see here, he says clearly motor vehicles for transportation of persons. That means it's very, very clear. 17 subsection 5 clause 1 applies to motor vehicles only for transportation of persons. That is, if there is a truck then which is used for transportation of goods, then that is very much, ITC is very much allowed. So that is what is this question here. Maintenance and repair services from Jaggi Motors, a truck used for transportation of finished goods. This particular situation, ITC is definitely eligible. Fine. I hope that is clear. Now let us look at another problem. X manufacturer of roofing sheets having rupees 1,60,000 as opening balance of ITC for June month. He provides the following information pertaining to goods and services procuring during the month of June. Input tax on raw materials 40,000. Raw materials used for making both taxable and exempt supplies. That means common ITC. Input tax on catering services procured from harvest caterers in connection with housewarming ceremony 10,000. Input tax on raw materials used exclusively in manufacture of exempt supplies of 2,20,000, not allowed because it is purely allowed for use for exempt supply. Input tax on cosmetic and plastic surgery of manager of factory 30,000. Total taxable turnover is 60 lakhs exclusive of tax. Compute ITC created for the month of June to the electronic credit ledger and net GST payable from the electronic credit ledger by X for the month of June. Rate is 18%. Subject to the information given above, assume that all conditions necessary for availing ITC has been fulfilled. All purchases are made from registered suppliers. Please try to answer this. You have to examine each item and decide how much is to be credited to the credit ledger. It's pretty simple. Please try to answer it. So if you look at the first one, input tax on raw materials of 40,000, it is used for both taxable and exempt supplies. Both taxable and exempt supplies. So therefore, if it is a common credit used for taxable and exempt supply, the question is asking is how much it is credited to electronic credit ledger and then net GST paid. We'll come to that. First is how much to be credited to credit ledger. So the moment it is a common input tax credit for taxable and exempt both. So first thing is it can be credited to the electronic credit ledger. Next one. So this is clear. Next one, catering services procured from harvest caterers in connection with housewarming ceremony. Two things are there here. First, outdoor catering services totally blocked unless it is a part of the composite supply. There also it is blocked. Second one, housewarming ceremony. It is not in course or furtherance of the business. So therefore here, outdoor catering blocked as per 17 subsection 5. And also supply not in course or furtherance of the business. Okay, this is what has to be this. Fine. So therefore, second one is not allowed. Next one. Input tax on raw materials used exclusively in the manufacture of exempt supplies. This is very clearly not allowed. The very definition of input tax, the very concept of input tax is that if it is totally attributable to exempt supplies, then no credit is allowed. This is also crystal clear, right? Next one, cosmetic and plastic surgery of manager 30,000. As is again 17 subsection 5. Clearly has health, beauty services not allowed. Without any condition, not allowed as per 17 subsection 5. Okay, this is also clear. Fine. So therefore, the amount which is credited to the should be taken to the credit ledger is only one amount, which is 40,000. 40,000 should be credited to the credit ledger. Now, what is the next question he's asking? He's asking what is the net GST which is required to be paid. So how do we arrive at this one? You have to find out what is the credit which is attributable to the exempt supply, and you have to reverse the same. So that is what first you have to do. So therefore, first what you do is calculate the GST on the taxable turnover, and after that, from there you have to remove the respective ITC. So therefore, if you check this problem here, if you see total taxable turnover is 60 lakhs, he says. 1 minute, let me just go back to our working sheet. You see here, you have to first calculate. He's asking the cash from the cash ledger. So therefore, GST on taxable turnover. How much is that? 60 lakhs into 18%. Rupees 60 lakhs into 18%, which is 10,80,000. This is the outward supply. Tax on outward supply, then less ITC, input tax credit. He also says in the problem that is an opening balance is there in the credit ledger. Opening balance in credit ledger. How much is this one? Opening balance in credit ledger rupees 1,60,000. Okay. Then what is the ITC credited to the credit ledger? How much is rupees 1 lakh? Sorry, rupees 40,000. Then less ITC attributable to exempt supply to be reversed, has to be taken into consideration. So how much is that? If you see total ITC common credit is 40,000. So 40,000, okay, into exempt turnover by total turnover. So what is the exempt turnover and total turnover here? Taxable turnover he is giving 60 lakhs. Okay. Input tax used in the manufacture of exempt supply of 2 lakhs. If you see, the question is given in a very, very tricky manner. It is hidden somewhere. So therefore, 2 lakhs is the exempt. Total turnover is 62. That is 2 by 60. So 40,000 into 2 lakhs divided by 62 lakhs. Fine. Which comes to 1290. So 1290 is credit to be reversed. So therefore, here if you see, add the less, it will be less credit to be reversed is 1290. Okay, so 198,710 is the ITC. ITC 198,710. GST 10,80,000. Net GST payable is GST. This is 10,80,000 minus 1,98,710, which is 881,290. 881,290. Fine. I hope this problem is clear. Fine. See here, he has given this problem. Manufacture of exempt supplies of rupees 2 lakhs. This is where you have the turnover of exempt supplies. So you have to read the problem carefully. If you miss out that figure, you'll be very confused as to where to search for that figure. It will be a problem. Fine. So this is clear. Okay, now we come back to the problem on IHD, which we missed out here. We'll just do this now. Just go through this problem and try to work out. Then we'll also look at another problem based on 4043. Please try to work out this. XYZ Limited, having its head office at Mumbai, is registered as IHD. It has 3 units in different cities, situated in different states, namely Mumbai, Jabalpur, Delhi, which are operational in the current year. Mrs. XYZ Limited furnishes the following information for the month of July. CGST paid on services used for Mumbai unit is 3 lakhs. IGST, SGST and SGST, CGST is 12 lakhs. Total turnover is as follows. Please determine the ITC. Turnover 10 crores. Turnover of Mumbai unit 5 crores. Turnover of Jabalpur unit is 3 crores. You have to determine what is the ITC which is available. That is the question. Please try to answer this. So you have to determine the ITC here. So therefore, based on the turnover, you have to pro rata divide it. That is what has to be done in this particular situation. So in this situation, what is he saying here? The credit distribution have to be taken into consideration. So therefore, here, if you see in the question, CGST is paid only for services used for Mumbai unit. CGST paid only to services used for Mumbai unit. So therefore, CGST for services in Mumbai unit. Okay, it should only go for Mumbai. Okay, only should be attributable to Mumbai. That is 3 lakhs is only for Mumbai. Now IGST and CGST for all the units, total comes to 12 lakhs. 12 lakhs. So here IGST rupees 12 lakhs to be apportioned on the basis of turnover to Mumbai, Jabalpur and Delhi. What is the turnover? Mumbai is 5 crores, Jabalpur is 3 crores, total is 10, means Delhi is 2 crores. So therefore, Mumbai is 5 crores, total is 10 crores. So IGST Mumbai is 6 lakhs because 12 lakhs divided into 5 by 10. IGST, CGST and SGST, all three. He didn't give the bifurcation. Then Jabalpur is rupees 3,60,000 and Delhi is rupees 2,40,000. This is how you are supposed to apportion the credit in the IGST fund. Proportionately distribute the credit. Fine, that was one problem. Now we go to another problem which is based on rule number 42. I think this problem we finished. Yeah, this next one. XYZ, this problem is slightly long. Let us go through this point and then you can try to work it out. XYZ Private Limited is a manufacturing company registered under GST in the state of UP. Manufactures 2 taxable products, alpha and beta, and 1 exempt product, gamma. On 1st October, while product beta got exempted from exemption notification, exemption available on gamma got withdrawn on the same date. The turnover of alpha, beta, gamma. So that means here what is happening? 2 products, alpha, beta, were taxable. 1 exempt product, gamma, was there. Then 1st October, beta became exempt and gamma became taxable. Turnover in the month of October was 9 lakhs, 10 lakhs and 6 lakhs. Details are given. Machinery use. So this question is a comprehensive question on section 18. How to claim the input tax credit with regard to exempt became taxable and taxable became exempt. That is exactly what we have to see here. Machinery U purchased on 1st October for being used in manufacturing all the 3 products. 2 lakhs, GST is 36,000. Machinery V, which is used in manufacturing alpha, gamma, 1 lakh, GST is 18,000. Machinery W exclusively for beta, 3,54,000. Y purchased on 1st October 4 years ago for being exclusively beta. For 1st October, it will be used for manufacturing gamma, 4 lakhs. Machinery Z purchased on 1st October 2 years for being used in all 3 products, 3 lakhs. All GSTs are also given. Raw material on 5th October, 1 lakh 50. On 10th October for beta, multiple products are multiple variations are given. So here you have to calculate the ITC credited to the credit ledger for the month of October, aggregate value of total input tax credit, common credit attributable to exempt supply, GST liability paid to the credit ledger. Assume that everything are from states other than UP, rate of IGST is 18%. Fine. So this is a comprehensive problem based on section 18. Please try to work out this. So here what you have to do is how to approach this problem. How to approach this problem? First, you have to calculate the ITC which is to be created in the electronic credit ledger. That is the most important point. Once you get the ITC created in the electronic credit ledger, you have to look at the common input tax credit. So here, what is the amount of ITC created? Let us look at machinery purchased on 1st October for manufacturing all the three products. What is exactly this? All three products, it is this thing, that means it is common input tax credit. So straight away, you have to take it to the electronic credit ledger. So this 36,000 will get credited to the electronic credit ledger. Second one, it is used for the products alpha and gamma. The moment it is used for the products alpha and gamma, it is again for both the taxable and the exempt product. 18,000 will be here. So if you see here, what does it say? It's used for alpha and gamma. So exempt product is gamma and alpha gamma got withdrawn. So that means gamma also became taxable now. So this 18,000 has to be also taken to the credit ledger. Then machinery W purchased exclusively for beta. W exclusively for beta. Again, here what is happening? For beta, if it is being used, it is totally used for exempt products. That means totally it will not be taken into consideration. So if you see machinery W exclusively for exempt supply will not be taken into the electronic credit ledger. So therefore, machinery W will not be taken. Machinery Y purchased on October 4 years ago for being used from 1st October, same machine will also be used for manufacturing product gamma. Machinery Y was purchased 4 years back, he says. For both taxable and supply, it was being used. Prior to that, it was used only for taxable. Therefore, when you have already used it for the taxable, you have already taken the ITC on it. So there is no question of taking ITC here because he was earlier used for manufacturing product gamma for exclusively in product beta, which is a taxable product. Credit already taken, no question of any credit now. Machinery Z purchased on 1st October 2 years ago for manufacturing all the three products. All the three products, machinery Z is being 2 years ago. So therefore, here also all the three products, already it must have been credited to the credit ledger. This will not. Raw material used for manufacturing alpha. This will be taken into the credit ledger of rupees 27,000 because it is purchased and it is being used. Raw material for beta will not be taken because it is exempt. For gamma, it will be taken. So 18,000 will be added to the common credit in the electronic credit ledger. Then you have to first, after finding out the electronic credit ledger, you have to find the common credit, add the total value, and then attribute it to the amount of exempt supplies. Exempt by turnover by total turnover. Then GST liability will be calculated. These are some hints for working out this problem. I want all of you to try this problem at home. And of course, in the next class, we'll work out this one. Kindly don't refer to the solution because it's a very famous problem in GST. It has come multiple times. But I want you to use your existing knowledge of the respective rules 42, 43 and work out this problem. We will look at the solution obviously in the next class once we continue our discussion. So therefore, with this now, we almost have come to the end of input tax credit chapter. Problems are left out, multiple problems will be worked out. And now, so there are few sections which are left out. We shall cover them in our next session, which will be on Saturday at 6 p.m. Saturday 6 p.m. will cover those balance left out provisions. We'll work out around as many problems as possible because we have 2 more classes dedicated to ITC. Next session we'll work out for problems, and then the final session on Tuesday we will look at the job work provisions and the problems based on job work we can work out. And also, as I told you, since the supplementary study paper has released, all the amendments relating to the first few chapters which we covered in the previous live coaching classes, we shall run through them also. So this is the agenda of the next 2 classes. Any queries till now? Fine. So kindly revise everything because ITC can get slightly complicated. It may become a bit more confusing. So, but don't worry. The moment you work out problems, you'll understand that if you read the provisions and rules, it appears as if it is very complicated, but it is not that complicated. It is definitely understandable, and we'll be able to definitely look at all these and able to work out the problems, and we'll work out multiple problems. Don't worry about that. Work out multiple problems, and from the exam point of view, exhaustive problems we will cover. So I request all of you to kindly not to miss the next session, because we'll start off with the solution of this problem and look at multiple problems which are there in the study material, and also some case studies which will be there. Thank you very much. See you on Saturday at 6 p.m. Good night.